It's November 4th, 2025, and the markets just sent a chilling message. The Nasdaq cratered 436 points, down nearly 1.84%. The S&P 500 said 1.05%, about 72 points. And the Dow, another 240 points, gone. But this isn't just a bad day, it's the beginning of something bigger. Palantir, PLTR, collapsed by around $19 and 23 cents at 187 or 188.6. IBM is slashing thousands of jobs, tech is bleeding, AI hype is fading, and Wall Street 6 month rally could vaporize in hours in 2026. This is the tremor before the quake. Red cut couldn't save us. Earnings beats couldn't hold the line. Inflation may be easing, but investors' confidence is evaporating fast. Is this the start of the 2026 downturn or just the first domino? Buckle up. The next 60 days could rewrite everything. Global equity markets have been on a euphoric run through 2024 and 2025, fueled by record earnings, AI enthusiasm, and expectations of Federal Reserve rate cuts. But history reminds us when optimism peaks, risk often hides in plain sight. Today, valuations are stretched, AI spending is ballooning, and geopolitical uncertainty is growing. The stage is quietly being set for a major market correction in 2026, potentially in the range of 10 to 20%, according to multiple financial institutions and strategists. The euphoria of 2025 by market still looks strong for now, despite the volatility seen in early November, where the Nasdaq plunged 446 points, as I shown you earlier. The S&P 500 dropped 1.2% and the Dow Jones lost 263 points. The broad trend in 2025 remained upwards. Corporate earnings are still solid and big tech continues to drive indexes higher. According to Barron's Big Money poll, nearly half of institutional investors remain bullish, expecting further gains into 2025, supported by productivity gains from artificial intelligence and improving profit margins. The Federal Reserve has signaled potential rate cuts in 2025, which could keep illiquidity abundant and sustain the rally a bit longer. However, this is likely the final leg of the bull market. Why the 2026 downturn is coming? Let's talk on that. Valuations are at unsustainable levels. The forward P ratio of the S&P 500 stands above 22, one of the highest in 25 years. The Buffett Indicator, market cap to GDP, exceeds 200%, far above the 120% level that historically signals overvaluation. The Shiller cap ratio hovers around 39, the same zone seen before the 2000 bubble crash. And these are the sources from IMF Global Financial Stability Report, Business Insider, and Chronicle Journal and Nasdaq. Second is the AI spending bubble. Corporations such as Nvidia, Microsoft, Amazon, and Meta are spending tens of billions to build AI infrastructure, data centers, GPUs, cloud capacity, faster than revenue is catching up. Economic Times and Barron's have both warned that this AI arms race resembles the 1999 dot-com build-up, heavy capital expenditure followed by disappointing returns. If these investments fail to yield quick profits, margin could contract, triggering earnings downgrades and valuation resets across the technology sector. Third is the corporate layoff and structural weakness. As reported just today, in recent months, IBM has announced thousands of job cuts and over 61,000 technology positions have been eliminated in 2025 across major firms like Microsoft, Google, Amazon, and CrowdStrike. This trend, reported by Bloomberg News and Times of India, indicates that companies are quietly bracing for slower growth. Rising layoffs often foreshadow a shift from expansion to cost control, a late cycle indicator of weakening demand. And fourth is the geopolitical and fiscal headwinds. Barron's and The Guardian have highlighted multiple global risks, including US China tensions over technology and trade, Middle East conflicts raising energy and defense costs, record US debt to GDP exceeding 120% by limiting fiscal flexibility, US elections introducing policy uncertainty into 2026, and last, JP Morgan CEO publicly stated he is far more worried than most of the Wall Street about a potential market fall within the next 24 months. Next is the monetary policy. All bets are off after 2025. Barron's noted that while the Fed's path looked clear through 2025, by 2026, the outlook becomes far more uncertain. If inflation proves sticky, the Fed may pause or reverse its rate cuts, leaving the market vulnerable to sudden repricing. Let's look at the historical parallels. 2000, 2000 dot-com bubble, valuations soared, capex exploded, and the Nasdaq fell 78% over 2 years. Housing crisis of 2008, excess leverage and euphoria preceded the minus 55% S&P collapse. Then the post-COVID rally 2020-2021, record liquidity and speculative trading led to a 25% downturn in 2022. Each cycle shared the same pattern: exuberance, and if I'm pronouncing correct here, complacency, overinvestment, and correction. The AI boom of 2024-25 shows all four stages forthcoming, forming again. That brings us to the question how retail investors like you and me can prepare. The first one is reduce exposure to overvalued AI leaders. These names may remain strong in 2025, but are most vulnerable if sentiment turns downwards. The first one is Nvidia, followed by Tesla, Palantir Technologies, supermicrocomputers, and meta platforms. These are just a few names. And second is rotate into defensive cash flow rich companies. When growth slows, stable earnings matter more than hype. The companies like PepsiCo, PEP, consumer staples and pricing power, PG, Procter and Gamble, which has essential household products lineup. Third is Johnson and Johnson, J&J, which provides healthcare stability. Fourth is UNH, United Healthcare Group, with the recurring revenues. And next is COST, Costco, which has a strong membership base. And ETFs, something like XLP, which is the consumer staples, and XLV in a healthcare sector. Third is increased safe haven and income exposure. Gold and precious metal. ETFs as GLD, IAU are the classic hedge during equity stress. One can also look at short-term bonds, SHY, BIL, which provides yield and liquidity. And then comes volatility hedges such as VIXY, VIXM, which provides which is for advanced investors only. And the fourth is crypto. Someone can maybe allocate less than 5% in the crypto, such as BTC, ETH, which has a potential asymmetric return but high risk. This is just a table to show what could be done or what someone can think about in 2026. If someone has a high growth AI and currently allocated 40%, trader can trim down during the downturn to about 20 to 25%. Defensives, which is currently maybe 20%, the trader can increase to 30 to 40%. If you are in bonds and cash 10%, you can increase to 15 to 20%. Gold and other hedge assets. If you have 10%, you can increase to 10 to 15%. And others are opportunity value buys. If you have 20% allocation right now, you can add post correction. And lastly, we have seen this movie before. When valuations soar and fear disappears, the correction is only a matter of time. The IMF, Barron's, Nasdaq, and JP Morgan are still issuing warnings. Tech layoffs are mounting, AI spending is unsustainable, and geopolitical tensions are rising. The rest of 2025 may still look like a party, but 2026 could be the hangover. Investors who prepare now by diversifying, reducing excess risk, and keeping cash ready will be positioned not only to survive the downturn but profit from its aftermath. The bull run isn't eternal, the time to prepare is before it ends. That's all for now, folks. I have just published best stocks to buy in 2026. These are the top 14 fintech stocks. I have also published best stocks to buy now. Please go through it. Please comments below. What are your thoughts on it? And I'm also going to publish 10 steps to financial freedom. So just watch for that video as well. Thank you for watching, and I'll see you in my next video.